Welcome to Vested Interest. This is Shane, and before we get into the video, I'd like to take a moment to thank everyone who's taken the time to watch, comment, and like the video, and a special thank you to those who subscribe to the channel. I really do appreciate it. And if you have not done so and taken the time to subscribe yourself, go ahead and hit that thumbs up if you find any value in the content at any time, and hit that subscribe button and the notification bell down below so you're notified whenever we post any new videos. For those of you who may be stopping by for the first time on the channel, well, it's not rocket science. In my opinion, the best way to do anything, keep it as simple as possible. So it really boils down to consistently investing, buying dividend growth stocks and growing companies with positive cash flow that covers the dividend, companies with a high return on their invested capital. I utilize both the dollar cost average approach, consistently investing into the stocks within the portfolio on a minimum of a bi-weekly basis whenever I get paid. Really, it's every week. You'll see a portfolio like this every week unless I think I missed 1 week last year where I went on vacation and didn't do any investing, but I still posted the stock pick of the day videos for the most part. I am coming up on another vacation here at the end of the month, and I probably will not be doing videos during that time. We're just going to a place where it's going to be much more difficult, excuse me, to get videos in. So apologies for that. But like I was saying, it really comes down to consistently investing into the portfolio, and that is what the portfolio update videos are about. We did add $1,457 in new capital into the portfolio. I also do a stock pick of the day series throughout the week, Monday through Thursday, so stay tuned for those. And with that said, let's jump right into the video. And we did have some dividends paid out this week, March 1st and March 2nd. Both days we received some dividends, and actually here on March 1st, we received our last payment from Intel, ticker INTC. We did sell out of this position. That's why it did not go back in and reinvest and buy more shares. We are no longer in Intel. Possibly if this pulled back considerably, maybe back down into the teens, we might look at it again. But for now, I'm not interested. They did come out recently and say they were not going to cut the dividend and then turned right around and cut the dividend. So whenever I lose faith in the management of a company after they've kind of led you to believe one thing and then within weeks do another, that is not a good sign in my opinion. So we may revisit them in the future, but for now we have sold out of that position. But we did receive $52.79 in our last dividend payment there. Enbridge, ticker EMB, out of the energy sector, they also paid out. They paid out $64.08. We do have the DRIP set on, dividend reinvestment plan. So that means whenever a company like Enbridge pays out, it automatically goes back in and buys more shares. So that $64.08 did pick up 1.66834 more shares of Enbridge, ticker EMB, out of the energy sector. So the $116.87 paid out in dividends. This 52 we haven't reinvested yet. That'll be part of next week's investments. But the Enbridge 1.66834 shares did add $5.93 in additional passive income to the portfolio over the next year. Then we started our first investment activity on the last day of the trading day for February 28th. We actually bought 24 shares of Medical Properties Trust, ticker MPW. This is a REIT out of the healthcare space. They deal with elderly healthcare facilities. And we invested $248.04, picking up those 24 shares at $10.34 per share. All told, those 24 shares of MPW added $27.84 in future passive income. And we weren't done. We went back to work and bought a little bit more, $1,209.31 total in capital invested on March 1st. And with that fund, those funds, the $1,209, we picked up 22 more shares of Medical Properties Trust, ticker MPW, the same REIT. You'll see here $10.08. They did dip down into the $9 range. I didn't get them in the $9 range, but we did get them just above $10 even, $10.08 per share. So we added a considerable amount, over 40 shares there to MPW this week. Really big pullback. I like MPW, anything under $12.50 really. So down here in the 10s, I will probably consistently add as long as it remains in the $10 range. Excuse me. We added 2 more shares to our Whirlpool position, ticker WHR. This is out of the consumer discretionary sector. We are trying to fill out this position here. I'd like to get to 100 shares. We added those shares at $136.14. My cost basis, you'll see here in a little bit, but it's around $140, and I am buying anytime it's under my cost basis. Johnson & Johnson, big pullback, set a new 52-week low here over the last week. Ticker J&J, out of the healthcare sector. We did add 2 more shares at $152.53 per share. Another one I am going to continue to add till I get to at least 100 shares, as long as it remains below my cost basis. And last up, we added 3 shares to our Procter & Gamble position, ticker PG, out of the consumer staple space. And we added those 3 shares at $136.76. And I really like Procter & Gamble now that it's pulled back under that $138 per share range. All told, the addition of that $1,209 and these shares in these companies here added another $59.51 in future passive income. All total, we invested $1,457 and some change, 34 cents there, in new capital into the portfolio. And with the dividend payout that we saw on the very first page from Enbridge, the MPW purchase we saw from the previous slide, and these purchases here, we added $93.28 in new passive income. So almost $100 in annual passive income here added to the portfolio this week. Very nice to see that. Nice increase in future income. Now, the sector allocations, how the portfolio is broken up by sector, is what I'm showing you here. And the communication sits at 9.4% of the portfolio. Consumer discretionary is 8.99%. Consumer staples, 5.95%. I'd like to build this out a little bit. Again, if Procter & Gamble stays under that $138 per share range, I will be a buyer there. Energy is sitting at 8.34%. Financial is sitting at 13.92%. No longer the largest piece of the pie here in financials. Healthcare is sitting at 8.80%. Industrials at 7.74%. This one has really shot up with some buys like Whirlpool, Stanley Black & Decker, a couple others in the Union Pacific in the industrial space. If we get some pullbacks, Union Pacific I'd like back under 200 per share. Stanley Black & Decker under 85. So those would be ones I'd like to add to. Whirlpool, like I said, if it's under 40, under my cost basis, I'll add to it there as well. Technology is sitting at 9.78%. Materials is now the 3rd largest position at 13.06%. And utilities, still no utilities, watching for a pullback on a couple companies there. REITs and real estate, and let me touch on that for a little bit. I am not in a hurry to buy any utility companies, right? I will wait for the price that I want, and then I will add to the positions that I've been watching. And that is a lot of what investing is about, waiting for a price. Don't overpay. Don't just buy stocks because you like the stock or you like the company. There is a value to the stock. When you are buying stocks, you are buying a piece of the company, so you need to be able to value the company, find the intrinsic value of the company, and then divide that intrinsic value by the shares outstanding, however many shares there are, and that should tell you what you should be paying per share, right? There are some great videos out there that would show you how to do that. There's also some, you can pay for some services that allow you to look at intrinsic value of stocks. There's some free services out there that you can look at. Google whatever stock you're looking at, intrinsic value of Union Pacific, for example, and look at the free data that's out there, and you can at least get a rough idea of what that stock should be purchased at. Okay, next up, we look at the largest position is now REITs and real estates at 14.04%. And we do have no ETFs. I consider the overall portfolio its own ETF. I built my own ETF, right? Now you can pause this. I'm not going to go through all of these, but here's the sector weights by the funds allocated. The whole portfolio, the totality of the portfolio is worth $119,005.16. And this is how it's broken up per sector by the money allocated to each sector. Next up, I always do this every week. Sorry, I'm hiding myself back there, but this is the overall total portfolio, all the positions within the portfolio, their ticker, right? The total shares of each of those positions, the current price as of close of business Friday, the market value. My market value currently would be the total shares times the current price. The average, my average cost per share is here. And the purchase price is just the total shares times the average share per cost is my purchase price in the position. So that's how much I have into it. Here is whether I'm up or down, how much I'm up or down, right? Red means I'm in the negative, means I'm down. And the, just black regular font is in the green. And then same thing here, percentage, whether I'm up or down, what the percentage of that down, right? I'm up 13% in Ally, I'm down 7% in Bank of America, up or down 1.62% in Cisco, right? Up in Enterprise Product Partners, up in HPQ, down in Johnson & Johnson, so on and so forth. You can pause this and look at where I'm at, totality, the sectors here, whether they pay out quarterly, monthly, or semi-annually, and how much they pay out is in these three columns here. The current dividend yield, again, as of Friday. Cost on yield, that's my cost basis, my yield, what my cost basis is based on, right? So you'll see that the ones that are in the green, where I'm up 13.5%, my yield on cost is much higher, right? I have a 4.4% yield on cost, but the current yield is lower. So if I purchase these positions that are in the green, I will bring down my yield on cost based on the current yield. Here's the portfolio weighting. What percentage? So we saw on the previous slide, we saw how the percentages are broken up by sector. This is by position. So what the percentage of Ally is, 2.5% of the portfolio. Bank of America, 6.34% of the portfolio. Cisco Systems is 6.16% of the portfolio, so on and so forth. Again, you can pause that and go through this. Estimated annual income, how much I'll make per year per position. That's this column. What months they pay out, and the dividend growth, at least the recent dividend growth for each position as well. Down here are the totals. Again, portfolio value, $119,005.16. My purchase price, so I have $120,060 into the portfolio. It's currently down $1,054.86, so I am down 0.88%, not quite a percent down. My current yield is 5.134%, and my yield on cost is 5.089%. I'm very proud of that a little over 5% current yield as well as yield on cost, which really the yield on cost is what I like to see. My estimated annual income. Now this is really what the portfolio is all about, whether the stock market's down, up, floating, whether the market's down, up, down, floating sideways. The portfolio continues to kick out these dividends. These continue to go up week after week, currently sitting at $6,110.07 in passive income. I do nothing for this income except buy and hold the shares in these wonderful companies here, right? That is what is great about this. These are paychecks that continue to come in quarter after quarter, month after month, right? You can see that every month really I get a payout. Some dividends like Realty Income pay out every month. So very nice. And my average dividend growth is 9.04%. Well, that is it. A quick walk through my portfolio. Hopefully your portfolio saw a bit more green, though I say it a lot. I don't mind the red days. Whenever I see the red days, those are buying opportunities. I look at them as sales on stocks I am going to be buying anyway, and I obviously want to buy what I'm going to buy as cheap as possible. When I walk into a grocery store or a retail store and see something I want to buy on sale, I don't get scared and say, oh, what's wrong with it? I better not buy it. It's cheaper today. I buy it, and if I can afford it, I buy more at cheaper prices. It increases my yield, it increases my future return, and it decreases my cost basis and the potential risk associated, right? The cheaper you're buying something, the less risky it actually is as well. Well, as always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Drop a comment down below. Let me know what you think of the video. Let me know what activity went on in your portfolio. Did you have any buys this week? Did you have any sells? Were you paid any dividends? Drop it all down below. I do personally read and respond to the comments. I'm always interested to read your questions, opinions, or suggestions for future topics. If you have some stocks you'd like me to cover in the Stock Pick of the Day series, go ahead and drop it down below. And I do read and respond to the questions and comments on the day of the video, guys. And some of these videos that have been out there for a year or more, I'm getting some comments on those. So it's not that I'm ignoring you. It's just I do not have the time to answer questions from videos months and months in the past. I do have a job. My wife likes to see me. I do have 2 kids. This is just a hobby for me. I do not get paid from YouTube. It is, again, completely a hobby. You don't even have the ability to monetize a channel until you have 1,000 subscribers. So help me get to 1,000 subscribers, and maybe I can answer some more comments and questions if I can be able to do this full time. But I'm sure you need hundreds of thousands of subscribers. I just hope that seeing this on a weekly basis, seeing a portfolio actually built out by a common guy. I go to work every day You know, I'm not really a 9 to 5. I'm more of a 7 to 5, pretty much, Monday through Friday type of worker. Grew up in a double wide trailer, so if I can do it, you can do it. If you have not started your investing journey, go ahead and join me on this journey to financial freedom. There is a Webull link down below. If you use that link to sign up for your brokerage account, you'll get some free, put some money in there, start investing today. If you have not, it's the only way to financial freedom, in my opinion. And I prefer dividend growth stocks. Maybe you're a dividend growth stocks. Maybe you're just a growth stock, or maybe you like index funds or ETFs. That's fine too. I like individual dividend growth stocks. That's my personal preference. But just be buying assets in great companies with a great future that you know is going to be here for the next 10 years, and get them at the cheapest possible price, right? And try to learn. If you don't know how, maybe pay for a service to understand, or reach out and find those free services out there and figure out the intrinsic value, what you should be paying for a share of a company, and don't overpay for it, right? Set that precedent. For Apple, for example, I like it when it's 130 or below. Whenever it hits there again, I'll probably add it into the portfolio, right? A lot of my other positions, I give you the prices throughout the week that I think that they're worth. 140 for Whirlpool, for example. Anything below that, I'm a buyer, right? Well, I'm going to stop rambling. I just wanted to throw that out there. Hopefully these videos are helpful to somebody. And this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, we'll see you in the next one. Hope you had a great weekend. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I'm only sharing my opinion and investing journey for educational and temporary purposes. Investing involves risk, and lose money. You should never invest any amount you're not comfortable losing. Always do your own research, invest based on your situation, circumstances, and selected criteria, or seek the advice and counsel of a certified financial advisor.